Hi there folks, it's James Marley here, co-founder at Livewire Markets, and welcome to our C-Suite reporting season coverage for August 2025. Today I'm joined by Arnie Selvarajah, who's the co-CEO of Bell Financial Group. We're going to dive into their latest results and speak more broadly about the future for Bell Financial Group and some of the plans that Arnie has for the business. Arnie, thanks for coming in. Great to catch up and appreciate you taking the time to have a chat with us.
Thank you, James. Nice to see you again and thanks for having me.
I think a lot of this conversation will gear towards what lies ahead, but to start off with, maybe touch on the key numbers from the latest result and the ones that you think investors need to focus on.
Thank you. We released our results last week for the first half 2025. We're a December year end, so 30 June was a half year result for us. Our revenue was $121 million. It was down 12% on the same time last year. And our profit was just over $9 million. Once again, down 44% on the same time last year. Now, there's a couple of elements in there. We had a very strong first half last year off the back of some strong ECM revenues and activity. And so that was really one of the impacts of the result. Underlying that result is the very strong result in our technology and platforms and products and services businesses. And they had those two divisions together represented about 38% of our total revenue and 100% of our result. So those two divisions had a net profit of $12.1 million. So we had a small loss in our broking business. And that's really because that business is leveraged to the markets and was impacted really by some of the volatility and the uncertainty in the markets in the first half, predominantly around Liberation Day in April and some of the uncertainty that surrounded that, and also some of the geopolitical events that are going on around the world at the moment. Some of the key things to see in that number is, as I said, the technology and platforms and products and services business was a strong part of the whole, but that business also grew 17% half on half. It's an important part now of the broader Bell Financial Group result.
Arnie, you mentioned there the technology and platforms and products and services businesses, which are a source of recurring revenue for Bell. Could you explain why these were pretty early in the presentation and why is that part of the business such a focus for you?
If you roll back 15, 20 years ago, this was a traditional stockbroking business and subject to the volatility and the vagaries of the stock market. So the business would do very well when the markets were strong and then would be impacted when the markets were not. So these two divisions are relatively new. They're about 15 years old within the Bell Group. And let me just tell you a little bit about each of them. So technology and platforms is our business, which is our online execution and outsourcing business. So that has brands like Bell Direct and Desktop Broker, and they service self-directed investors, high net worth self-directed investors, and externally advised investors through our Desktop Broker brand. That business has about 190,000 clients, has about 43 billion in client assets, and so because it's quite broad and a large number of clients trading quite frequently, it represents a very strong earning stream for us within the group. The products and services business is exactly what it sounds like on the tin. It's where our products and services that we supply both internally to our clients, but also externally to third-party clients. So they include things like our cash solutions, our margin lending product, and also our portfolio administration services. And so that business also is very much driven around annuity revenue based on the assets that we hold on behalf of our clients. So those two businesses are important for Bell Financial Group because increasingly they create a floor of earnings to the group. So in this year, as I said, they're 100%, a bit more than 100% of our NPAT result. But over time, that floor will continue to grow and the volatility earnings that we get from our broking business will become a smaller and smaller component of the whole.
Arnie, earlier in the year, Bell Financial Group was involved in a bid for an online trading platform called SelfWealth. Ultimately, the bid wasn't successful. Another player outbid you in that particular opportunity. Is M&A still an option you're considering?
Yes, absolutely. So one of the core platforms of the business is the fact that we own all our own technology. So we have an end-to-end capability, and I would argue probably the only business in Australia that does. So we have client-facing websites, we have a middle office, which is our CRM capability, and we have a trading engine that connects directly with the ASX. So we have this capability that can service clients who are self-directed all the way to corporate and institutional clients. Because we have that technology, it's leveraged to scale. So we will continue to look for acquisitions where we can basically bring businesses onto our platform and achieve a high level of synergy because we have our own capability, our own infrastructure and our own technology. So certainly we'll continue to look for those where it makes sense. The reason we discontinued our bid for SelfWealth is the price point at which our competitor was bidding for that business got past the point where we felt there was value in our business. So we're very disciplined in how we allocate our capital. So we'll continue to look for acquisitions, but we'll only do that in a way that is incremental and accretive to our internal share price.
Now, Arnie, you touched on it before. The broking business had a challenging time. Is it just market conditions or were there other contributing factors?
It was mainly delivered by the volatility that we saw in the first half of the year. So it is very much a business that is leveraged to the markets. But having said that, we also issued a trading update at the same time as we released our half-year result. And the July result was a very, very strong result. So the NPAT in July was $7.4 million compared to the first 6 months of just over $9 million. So at the end of July, our result on a PCP basis was 8% down on the prior year. So a huge recovery in that July month. And that was really off the back of a strong month from our ECM business. And that is continuing into August. So I'm confident and that by the end of August, we would have recovered a little bit more of that deficit to last year. We're seeing very strong activity in ECM and particularly in three key sectors. Healthcare seems to be taking off again, and certainly we have some very strong local healthcare businesses which are leveraging their distribution and capability into other parts of the world. Defence is a very strong thematic. As we know, some of the directions that NATO is taking now, being pushed by the US, has driven a lot more spending in defence. So we have some strong defence businesses in Australia, and they're getting some tailwinds from that thematic. The other thematic is advanced manufacturing, which we're also strong in our ECM business, and getting good traction and getting good growth in those sectors. So those three sectors are strong at the moment, and we have a very strong pipeline into the rest of the year, particularly in those three sectors.
Arnie, in July, you announced a partnership with Praemium with a view to providing Bell Pod clients with a wealth management solution. Can you just tell us a bit about the rationale for this move and where it fits in the strategy moving forward?
We're really responding to client demand, and you'll see that there's been a shift generally, not just in Australia but globally, to moving to more of a more holistic wealth management model with all of the stockbroking firms. So the partnership with Praemium is really gives us the capacity and capability to move to that model in a much smaller time frame. We have an existing business, as I mentioned earlier, our portfolio and administration services, and we already have just under $6 billion in client assets on that platform. But that platform is internal, it's highly manual, and doesn't really give us the capacity to scale. So the partnership with Praemium is really about scaling that offering, and not just in terms of getting more of our clients across from a traditional broking model into a more holistic wealth management model, but the Praemium system or offering will allow us also to start offering services and capacity to invest in other asset classes. So they're strong in unlisted managed funds. We will have a fixed interest capability through the Praemium platform as well. So we know from some research we did on our own customer base that a third of our clients have 50% or more of their portfolio with somebody else. So the Praemium platform and now the ability to have a more holistic view of the client's portfolio will mean not just that we can service more clients in a wealth management way, but we will be able to address a bigger share of the clients' wallets for those clients who are already with us. So we think in our Bell Potter Securities business, in our advice business, we already have about 45 billion of client assets. If we think about the assets that aren't with us at the moment, that addressable market goes from that 45 billion to about 80 billion. So it really opens up the opportunity for us to service more of our clients' assets and obviously as a result achieve a higher revenue number.
And Arnie, what sort of milestones or goals have you set around that, converting some of those clients and bringing them onto the new wealth offering?
So currently, as I said, we have 6 billion. And if you look at the whole business, we've got, including margin lending and cash, we've got about basically 10% of client assets, of our total current client assets, that use internal products and services, including our wealth management service. So I think it's a low bar, and in that wealth management or PAS offering, we grow our FUM by about $500 million a year. So that's on the existing platform, which really wasn't scalable. I'm hoping that we should be able to double that quite easily. And our goal would be that we can get that 10% penetration to 20 to 30% penetration over the next 2 to 3 years. In our Bell Potter business at the moment, our mix of revenue is 20% recurring, 80% transactional at the moment. And I'm hoping that as we bring more into the wealth platform, we might be able to get to a 50-50 mix, in 3 years' time.
So Arnie, I read an interview you did with Boss magazine. You talked about needing to paint what the future looks like and how we might get there. So perhaps I can get you to do the same and sort of 5 years from now, paint a bit of a picture for how you see that, how you see the business and particularly that revenue mix of the 3 divisions changing.
So maybe if I start at how I'm seeing the big picture. And I think in Australia as an industry, we tend to segment the market based on what we do. So if you're in the advice part of the industry, you think everyone should have advice. If you're in the online part of the industry, you think everyone should be self-directed. But if you ask clients how they want to operate, they don't think about that in that context. They don't wake up in the morning and go, I think I'm an advice client. Or they wake up in the morning and they don't think, oh, I'm a self-directed client. All they think about is, how do I grow my wealth and get myself to a point where I'm independently wealthy, or I can be a self-funded retiree. So the way we're thinking about the business is we're trying to break down those silos. And arguably, I think we're the only business in Australia that straddles both online and advice, and we own our own technology. So what we've done in our business is all of the clients on our business are on the one technology platform, which means that over time, their ability to move from being self-directed to advised, or from advised to self-directed, becomes less and less friction. It'll become frictionless. So we will be able to service clients and meet them where they are at, rather than them meeting us where we are at. So we're building journeys for clients to move from being self-directed to being advised, and vice versa. And we know that clients will do different things at different parts of their life stage, or they might think differently about different buckets of money. They might have a discretionary portfolio that they are happy to be self-directed on, but a more meaningful portfolio around their superannuation, which they will want advice on. And so we're going to break down those barriers, and the business will look quite different in 3 to 5 years' time than it is today. And I think, hopefully, and I said we are the only business in Australia that straddles both, and I think we'll be able to service clients in a much more contextual way for them, rather than for us as an industry or as a business. So the mix of revenue is hard to predict, because I think it'll just be one set of revenues, which will be really centered around how clients want to operate with us.
Arnie, you sort of talked about the scalability of your technology platform. What about investment back into technology and marketing? Do you expect to have to lift that to support this growth?
We already have quite a healthy annual investment, both in technology and in marketing. So we've always been a business that reinvests profit rather than overinvests and hope to earn a revenue stream post. And so we'll continue that strategy. I don't think anything needs to change. There's certainly a shift in where and how you spend your technology dollar with the introduction of AI. So we're certainly turning our mind to that and working out how AI will help us, not just in building technology, but how will AI help us in our back office and operational components of our business, and ultimately in the front office piece. I think there'll always be a human involved, but certainly we can make our advisors, our research analysts, much more productive in how they do their day-to-day jobs.
Final question, Arnie, is there anything else you think investors should know about your plans with Bell Financial Group?
Look, I think what we're building and where we are today is a really interesting stock. We're a stock at the moment that is valued more like a full service broker. We're valued at 13 times NPAT at the moment. But we are made up of some businesses which arguably should be valued more like an annuity style business. So it should be valued substantially higher. But what's interesting about the business is at the moment, we're a stock that has an 8.7 to 9% yield, gross yield, based on our current share price. But one that also has a growth aspect to it when we hit that tipping point of recurring revenue versus transactional revenue. So it's a stock that effectively you can have your cake and eat it too. You'll get a good return in the interim period, but there will be a point where the actual share price will trigger and will tip into more of a growth stock, and you get a capital gain at some point in time. And that's how we're thinking about the stock, and that's how we're trying to build out the business.
Well, Arnie, thanks very much for coming into Livewire. Sorry I couldn't be with you there in person, but really appreciate you explaining your vision and plans at Bell Financial Group, and we look forward to following some future updates down the line.
Thanks, James. And we'll see you soon at Livewire Live.
I can't wait. It's going to be a big one.
Thank you.
I hope you enjoyed that interview with Arnie Selvarajah, co-CEO at Bell Financial Group. Remember, there's more C-suite reporting coverage on our YouTube channel. Make sure you go check it out.